Do you get confused between mergers and acquisitions? Or are you unfamiliar with what these terms are? Today we will help you understand them by giving you a few facts about mergers and acquisitions. This might not be familiar to most people, but this is common in the business world for businesses to survive, grab opportunities, and many more reasons. This will also be helpful for people who aspire to be businessmen in the future. Let us first know what these are, so watch this video and we will give you the things you need to know about mergers and acquisitions. Strategic partnerships between two or more companies are mergers and acquisitions, or M&A. When two businesses combine, they pool their resources and assets to form a new company. But in acquisitions, one company purchases more than 51% of the other company's stock. The primary distinction between a merger and an acquisition is that a merger involves the legal consolidation of two businesses into one. Still, an acquisition occurs when one company is absorbed by another, meaning the business buying the other business keeps operating. Here are 7 things you need to know about M&A to comprehend it better. Number 1. The first is a brief decline in share value. In general, the value of the acquiring company's share will temporarily decline in the days before a merger or acquisition. Additionally, the value of the target company's stock often increases simultaneously. This is frequently because acquiring company will have to invest money to buy the target company at a price above the pre-takeover share price. The stock price typically rises above each underlying company's pre-merger or pre-acquisition value once the merger or acquisition becomes effective. With good economic conditions, the combined business typically performs well over the long term and pays out dividends to shareholders. Due to the increased number of shares released during the merger process, it should be noted that the voting power of the shareholders of both firms may be diluted. A stock-for-stock merger is a typical example of this phenomenon when a new firm offers its shares in exchange for target company shares at a predetermined conversion rate. Shareholders of a smaller target firm may witness a severe erosion of their voting rights in the bigger pool of stakeholders. Shareholders of the acquiring company only suffer a slight loss of voting power. Number 2. Mergers and acquisitions are not just means of escape. You can't just leave and when you go through a merger or acquisition, especially if another business takes over your activities. Many unions and investments necessitate a time of transition, during which the entire executive team must remain on board. They also set up the new operations to ensure that the company will function well once everything is in place. Depending on the conditions and intricacy involved, the time required for this changeover varies, but it could be years. Being in this kind of arrangement is a little challenging, but it is finally attainable with hard work and effort. Number 3. Acquisitions and mergers sometimes resemble startups. A merger or acquisition causes many changes, and managing them requires much effort. Operations and procedures that were in place before the purchase or merger are modified or eliminated. Everyone has to put in more effort, as a result, to keep everything operating as efficiently as possible. Transition process can resemble a startup in many aspects, requiring significant work to invest in the organization's future. Because it's like starting over at step 1, it will take a lot of work. It is a small price to pay, as they say, for a larger good. Number 4. The fourth point is that mergers and acquisitions are tactics rather than strategies. Some individuals believe that a merger or acquisition is the answer to a firm's difficulty. The process will only be successful if your firm has a solid plan for the long term, even in the case of a merger or acquisition. Although a merger or acquisition can be part of a more comprehensive plan, it shouldn't be the strategy in of itself. If not, there won't be a plan for the company to be built for future success and durability once a change has occurred. There will be significant obstacles to overcome, whether you wish to investigate a merger or acquisition, to accomplish a corporate goal, or to win support and get beyond a roadblock. You can better understand the procedure and decide whether it is the right course of action for you if you know what to expect. Number 5. A bigger market share. The increased market share that a merger or acquisition might offer is one of the most evident advantages. By snatching up rival businesses in your sector, you can guarantee that a more significant portion of the whole market will be yours. Consider the now famous Exxon and Mobil merger in 1998. Before their union, the two companies were already the most significant and second largest oil producers in the US. Following the transaction, the company enjoyed a considerable market share and saw a 293% gain in share price. Acquiring large clients, mergers, and acquisitions are typical, particularly in the service sector. There are numerous instances of this type of merger and acquisition, or M&A, activity involving legal firms. As occasionally, clients are so large that it requires firms to merge to serve them better. The combined businesses are more equipped and experienced in dealing with influential clients. Additionally, it provides a mechanism for companies to generate revenue, improving listed businesses' stock exchange performance. Number 6. Growth. With little to no more work, mergers can allow the acquiring company to increase its market share. Instead, in what is typically referred to as a horizontal merger, acquirers pay a set sum to purchase a competitor's business. A beer firm might decide to acquire a small rival brewery to manufacture more beer and boost sales to brand loyal customers. There are more opportunities for market expansion when two organizations combine their expertise, assets, and market share. One business will now hold the whole market share that was previously split into two. More prospects for sales, revenue, and profitability will probably be created by the increasing market power. Number 7. Get rid of competition. Sometimes a purchase is made partly to stop a rival from taking similar action. Big businesses are constantly vying for an advantage over their competitors. Their need to position themselves as a leader in their industry can increase due to an acquisition or merger with another company. It's understandable why M&A is so well-liked, given their numerous significant advantages. Many M&A transactions allow the acquiring company to oust rivals in the future and increase its market dominance. The offer's drawback is that it frequently costs a significant premium to win over the target company's shareholders. Because the acquiring business paid too much for the target company, it is common for shareholders to sell their shares and drive the price down. People have created a lot of strategies to survive. Plan A does not work, then Plan B might be the best way. The same thing applies to businesses. If you own one, you need to be creative to stay on the radar, and M&A is just one of the thousands of solutions to keep one's business afloat. We hope this has helped you and might be helpful in the future business ventures. We wish you the best of luck. What do you think about this topic? Do you agree with me too? Share your thoughts in the comments section below. Don't forget to like, share, and subscribe. I'll see you in the next video.